The majority of the S&P 500 is in the red right now, and our focus in today's episode is going to be on Qualcomm that reported their earnings after the market closed yesterday. And not only are they down around 15% over the last month, but today they are down more than 7%. So let's understand why this company is crashing, and if for a very high quality one, now is a great time to buy this as an undervalued dividend company. Now, when we're looking at the earnings, the headline does read that they beat analyst targets, as well as their phone sales chips up around 12%, which is one of the metrics that Wall Street were keeping a very close eye on. Now, that is good news. Interesting to note, in fact, it is down today after these earnings. And when we look at the numbers numerically, we can see EPS 233, very nice beat from the analyst targets of 225. And the revenue, again, another nice beat, 9.39 versus 9.22 billion expected. On top of that, net income for the quarter was also very strong, 2.13 billion, with the same quarter last year 1.8, so a very large increase year on year. And one thing that we also wanted to point out from this article, maybe something you weren't very familiar with, but they paid out not just quite a significant amount in dividends this quarter, but also they repurchased around 7 million worth of stock for around 1.3 billion. So a very nice signal as we are about to look under the hood of this company at their metrics. So as we said, down over 7% today, negative 15% over the last month, but year to date they are still up a respectable 16%. Over the last year, up 27%. And if you've been a long-term shareholder, as we are about to show you, you would have outperformed the S&P 126%. Bear in mind that doesn't include dividends reinvested. We do also note all-time highs sits around the $230 mark, which we have seen just a few months ago. We still get a double buy rating, a hold from Quant. In terms of the yield, well, 1.9%, and a forward P sitting around 18 when the S&P itself sits around 23. So let's look at the underlying metrics. Firstly, dividend safety score sits at 80. It is safe, and they did increase their dividend this year, 6.3% in March 24. Always nice to see when it is above that minimum 4% inflationary target we target on this channel. Now, what does this mean? Well, dividend safety score of 80 effectively means that a dividend cut is unlikely, and it was just reaffirmed a few months ago. Now, in the last recession, as always, we look at the comparable data. 07-09, great recession. In fact, they had increased the dividend. They had above S&P growth, negative 6.8%, with the S&P itself negative 12%. And they also significantly outperformed the S&P, negative 21, with the S&P itself negative 55. Nice increases to the dividend, 6.3 this year, as we mentioned, 5% over the last 5 years, but over the last 20 years, on average, they have been increasing it at a rapid 20% rate. And we also note 20 years of consecutive increases, meaning they are 5 years away from becoming a dividend aristocrat. As always, we like to look at dividend yield theory. It gives us a sense of undervaluation when the yield sits above the 5-year average. Right now, we see it lower, 2.02 versus the 5-year 2.27. So you could argue overvaluation, but we do note something different on the forward PE. 15.6 versus the 5-year average of 16.3, so that is an undervaluation signal. And we also note significantly lower than the information technology sector at 25.7. Do bear in mind though, we never look at any one of these models in isolation, and we will conclude towards the end. Free cash flow, as always, over the earnings, which is susceptible to manipulation by management through accounting. Our blanket rule 60%, but for semiconductors below 50%. Now, pretty inconsistent on a year-on-year basis, but over the last 3 years, below 50%, and over the next 12 months at 31% anticipated, does mean that in 2025 in March, hopefully we can see a nicer increase, more towards the averages we have seen over the last 20 years. In terms of free cash flow per share, as always, consistent increases over the longer term. It has pretty much doubled from 2014 to 2023 and anticipated to continue that increase at a nice rate over the next 12 months. Then we move to sales growth. Now, we will look at this numerically as well as the bottom line net income, but what we want to see a minimum of 3 to 7%. Bear in mind, semiconductor as a whole, the industry is cyclical, hence why we do see 5 of the last 10 years showing negative growth. And when we do look at it from a numerical perspective, they have increased it over the longer term, 26.5 billion to 35.8 in 2023. As always, returning of excess cash to shareholders through those share buybacks is something we want to see through reduction of shares outstanding. We can see they have done it very inconsistently, but nonetheless a very rapid rate over the last 10 years. And as we mentioned, they did buy a significant number of shares just over the last quarter. ROIC, very important metric. For return on invested capital, you want a minimum of 10%, minimum 12% for semiconductors, to give us faith as investors that management are able to effectively allocate their capital. Above that pretty consistently, 43% in 22, and even after the drop to 2023, the 23% number still looks very strong for investors who do consider this in their portfolio. Operating margin as well, minimum 16%, which we get every year. 24% in 2023 looks nice, but ideally what we are looking for here are companies that show us operating efficiency through the increase of their margins on a consistent year-on-year basis. We then get to the free cash flow margin, above 5% for semiconductors, which we can clearly see, and even though it is inconsistent, the numbers are very strong. 28% over the last full year, 34% on a trailing 12-month basis, always great to see. We then end with the net debt to EBITDA metric, the earnings before the interest, tax, depreciation, amortization, below 1.5 for semiconductors. And why this is important? Well, it does correlate to both balance sheet strength, dividend safety, and the numbers that we see below. Number of years it would take the company to pay off all of their debt net of cash on hand. 0.35 in 23, expected 0.1 over the next 12 months. So this is a very solid company with a great balance sheet and a safe dividend. So we can anticipate over the long term very nice increases. What we also like to do is see the insider movement, 0.08%, and we note 22 million worth of sales over the last year by these insiders. But one thing is common, they do typically on a quarter-on-quarter basis tend to sell shares, so this shouldn't come as any surprise. And what we have noted in quarter 3, around 2.21 million sold by these insiders. Now, who they are, just for full transparency, we will show you, although we don't believe it to be a bearish signal, as they sell for many reasons, personal or financial. The more recent one, the 5th of July, although on the 1st we also see a tranche being sold by the Chief Technical Officer as well as the Chief Financial Officer, and between them they sold over 2 million shares. As always, if you want to incorporate it into your analysis, you can, but not something that we personally would do. We then look at the institutional ownership, just above 74%, around 9 billion worth of sales over the last year, although we see a lot more buying, around 14.4 billion over the same period. In the more recent quarter, we do see a marginal more buys from the institutions themselves, and over the previous quarters, Q1 as well as Q4 of 2023, we see something similar. Institutions have been buying more than they have been selling. Now, as always, do your own due diligence. Don't copy what institutions or the insiders do, but always nice to see and can form part of the wider investment thesis that you may have. Now, we also want to let you know we have released our latest weekly articles. If you want access to this or any others, you can sign up by clicking on the pinned comment below. And one of our more recent articles, we did just run through 35 undervalued August stocks, where we take a look at each one and we also depict which one we have in our own portfolio, as you can see, the first one being Visa. We then want to take a look not just at the revenue, which we have already seen, but also the bottom line. As we saw, the top line is inconsistent given the cyclicality of the industry, but when we take a look at the bottom line, we want to understand the story being told there, and we can see something very similar straight away on a graphical basis. The inconsistencies really come through, and they reported 8 billion on the bottom line in 2014. They've reported less in 2023 at 7.2, so something just to bear in mind. As always, with cyclical companies, we really ideally want to be buying them at the bottom of the cycle when they are particularly out of favor. Next thing we want to show is the health of the company, total cash versus total debt, and they had around 18 billion of cash and short-term investments in 2014. Latest quarterly report, this has come down to around 13 billion, and we can see the overall trend over the longer term has been a decrease of cash that they have held. As always though, do remember, very important, any number here in isolation doesn't tell us much, which is why we like to compare it numerically and directionally to total debt, which was 0 in 2014 and now sits around 14.5 billion. So over longer term, we do note that total debt has been decreasing from the highs of 2017, which is a good sign, and we did see the net debt to EBITDA looking very low, around 0.1, 0.2, so always a great sign, especially when you want to hold companies of high quality, and a strong balance sheet definitely meets one of those criteria. Next thing we want to look at is their earnings report, and what we note is over the last 4 quarters, they have beaten analyst targets as well as their more recent quarter, and moving forwards over the next few quarters, they are anticipating growth as well to the EPS. Always a great sign, and if they do hit that September 2025 EPS estimate, the forward P will come down to around 16.06, making it look even more attractive than the current P that we are seeing. Next, we want to look at some underlying metrics and the gradings. The first one is a D+, and that is the valuation grade that we're drawing your attention to. What we note, P on a non-GAAP basis around 18.25. The sector does trade higher, as we mentioned earlier. So in fact, in comparison, based on this valuation metric solely, you are getting around a 26% discount, something just to bear in mind. But when we do look at some other valuation metrics, for example, on a price to sales or a price to book, we can see it does trade at a premium, hence why it gets that D+ on the valuation spectrum. As always, when we do our own valuation towards the end, we will incorporate a margin of safety, so that can be used to incorporate some of these things that we are talking about today. Next one is the growth. Well, they get a D, year on year negative 11%, with the sector doing much better at 4%. Moving forwards, negative 2%. We can see again the sector positive 7%. And one of the things we always like to look at, EPS moving forwards over the next 3 to 5 years, 12% for Qualcomm versus essentially the sector median at 14.4. So not the greatest when it does come to the growth. No surprise then why we do see a D rating. And then what we find out is that on the profitability, they score an A+, which is nice to note given the valuation and growth left a lot to be desired for. We notice 56% on the gross profit margin, 49% sector median. Bottom line looking very strong at 23% when you notice the sector median at 3.21, and the cash from operations very high, 13.3 billion, where we note the sector at 98 million. So lots of things to consider, and as an overall summary, we still get a double buy rating with the hold from Quant, a D+ on valuation, a D on growth, with an A+ on profitability. We then want to see how they performed against others in the semiconductor space, similar size and essentially market cap. We have Texas Instruments, Advanced Micro Devices, Intel, as well as a few others, and we have reviewed majority of these on the channel. So over the last year, including dividends reinvested, so total return, Qualcomm is the second best performing. It is up in fact 29%, with the majority in the positive. So overall, the industry has done very well this year. When we expand it over the last 5 years, we notice again the second best performing, up 156%, which is a very respectable performance over this period. And then we zoom out even further, over the last 10 years, 202%. Not the second best performing, but nonetheless, in isolation, 202% is nice to see over a 10-year span. But as always, past performance is never an indicator of the future. They've done very well. Will they be able to do this again over the next 10? Again, just something to bear in mind. Now, finally, before the valuation, we want to show you its performance against the S&P 500. Ultimately, you want to invest in companies that will outperform the S&P. Otherwise, why go through all the hassle and headache? You may as well look at low-cost ETFs. So over the last year, including dividends reinvested, Qualcomm significantly outperforming the S&P. When we zoom out over the last 5 years, again, significant outperformance. And when we look over the last 10 years, that theme does continue. So over a 10-year, 5-year, and 1-year period, Qualcomm has been outperforming the S&P 500. So always a good sign, especially if this is one you are considering adding into the portfolio. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And our intrinsic value today at $209 isn't dissimilar from Wall Street's 211, where they have 26% upside over the next year. Now, how we got to 209, we ran it through the 4 valuation models. The first one, Graham's valuation, we have the stock ticker symbol, the EPS, long-term growth rate, AAA corporate bond yield to give us our intrinsic value of $175. So we get our first signal of undervaluation. Bear in mind, we're not looking at any of these models in isolation. We then have the multiples valuation, companies in the similar sector and size that we just ran through, and we can see based on that we get another undervaluation signal, a very significant one, which tells us that Qualcomm, in comparison to others in this space, does trade at a very low valuation. We then move on to the third model, which is the dividend discount model. As we can see here, very nice growth over the last few years, 7.04% to be exact. And we have gone lower, a bit more conservative at 6.25, which is lower than both average as well as the more recent increase. And we get a third undervaluation signal. We then move on to the fourth model, the DCF model, the free cash flow year on year, average at 17%. Now we have gone significantly lower at 10 and in line with analyst targets. With the discount rate, we get the present value of future free cash flow and terminal value, add together with the cash, subtract total debt, get the equity value, divide by shares outstanding, and as we can see, 4 for 4, all showing signs of undervaluation after today's drop. Now, as always, it is the average of these four models coming to $209, and you can grab a copy of this model by clicking on the pinned comment below and running through your own numbers, whether it's for Qualcomm or any other company. We then always on this channel use a margin of safety where we start off with 10% and we execute on this if it meets the 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. Now, if you believe this for Qualcomm, well, it is a buy up to $188. Then we keep going till it's near the current trading price, 178, a 20% MOS. And in today's episode, for a very strong semiconductor company, Qualcomm is offering 20% based on the estimates and judgments we just ran through today. Now, Wall Street also, as we said, see very nice upside of 26%, and bear in mind this company did just beat the analyst targets on both their revenue as well as EPS, and also their net income for this quarter was much stronger than the previous year's same quarter. As always though, do let us know your thoughts in the comments below. Is Qualcomm one you are considering on the drop that we have seen after the strong earnings? Or maybe this is one you are waiting for it to go even lower. For example, at a 25% MOS level, you would need to wait for around $157. As always, let us know your thoughts. If you enjoyed the episode, smash that like button, hit that subscribe and bell button so you are continually notified of the videos as we release them. And don't forget to sign up to the newsletter below so you do get our undervalued stocks throughout the weeks, as well as joining the Patreon if you want to discuss our weekly buys and sells. As always, have a great day and we'll see you all on the next one.